In today's video, we're looking at how you can start investing in stocks with little money. Whether you have $5, $50, or $500, I'll show you how to grow your money and get started in the stock market. When I first thought about investing, I always assumed you needed a lot of money to get started. Definitely more than I had anyways. I remember feeling overwhelmed, thinking there was no way I could make it work with just a small amount. But then I found out there are ways to start investing even with a little bit of money. It wasn't about having thousands to begin with. It was about starting where I was and making small steps that added up over time. Let's start with the first step, investing small amounts using fractional shares or ETFs. When I first began, the idea of buying a single stock seemed impossible. Some shares were hundreds, even thousands of dollars each. But then I learned about fractional shares. These let you invest in a piece of a stock rather than the whole thing. So you can own a portion of companies like Amazon or Tesla for as little as $1. It's an easy way to get started without feeling like you need a huge upfront investment. For example, there are apps like Robinhood or platforms like XDB, which I personally use, that offer fractional investing. These tools remove the barrier of needing lots of cash to invest and make it as simple as buying a coffee. If you've ever hesitated to invest because you thought you couldn't afford it, fractional shares completely change the game by making stocks accessible at any budget. Another great option to start small is ETFs, or exchange-traded funds. Think of an ETF as a basket of investments. It's made up of many stocks, so you get instant diversification. Instead of putting all your money into one company, you're spreading it out, which lowers your risk. ETFs often come with lower fees and are ideal for beginners who want to invest little amounts regularly. Now, let's talk about why fractional shares and ETFs are so powerful, even for small investors. First, they allow you to build a habit. By starting small, you're creating a foundation for future growth. For example, if you invest $10 a week in an ETF, that's $520 a year, plus any growth your investment earns. It might not seem like much at first, but over 5, 10, or 20 years, that consistent contribution can add up to thousands, even tens of thousands of dollars, thanks to compound growth. Second, fractional shares let you diversify without a big budget. Diversification is just a fancy way of saying you're not putting all your eggs in one basket. For instance, instead of using $100 to buy one company's stock, you could split that into 5 $20 investments in different companies or ETFs. This spreads your risk and increases your chances of seeing steady growth over time. And finally, many platforms today make it fun and engaging to start investing. Apps like Robinhood and XDB often come with educational resources, so you're not just throwing money into the market blindly, you're learning as you go. Some platforms even allow you to simulate investments with virtual money to practice before committing real cash. And if you're not sure where to start, many platforms also provide curated lists of stocks and ETFs tailored for beginners, helping you feel confident in your choices. Here's how I started. I set aside just $20 a month and used fractional shares to build my portfolio. Some months it felt small, but over time, I realized the consistency was what mattered. Whether you have $5, $50, or $500, the key is to just start. These small investments grow over time, and thanks to compounding, even a little bit can turn into a lot. So, take a look at some of the platforms available in your area, and don't be afraid to start small. The important thing is to begin, because as I learned, waiting for the perfect time or enough money only hurts you in the long run. Once I learned that I didn't need a lot of money to start investing, the next big lesson was understanding the power of consistency. This is where dollar cost averaging comes in. A simple strategy where you invest a fixed amount of money at regular intervals, no matter what the market is doing. It might not sound flashy, but it's incredibly effective. Here's how it works. Let's say you decide to invest $25 every week. Some weeks, the stock prices might be higher, so you'll buy fewer shares. Other weeks, the prices might be lower, and you'll end up buying more shares. Over time, this evens out the cost you pay for your investments and helps protect you from the risk of buying everything at a high price. It's all about staying consistent and letting the market's natural ups and downs work in your favor. When I started, I didn't have hundreds of dollars to throw into the market at once, but I made it a point to set aside $10 a week. It didn't feel like much at the time, barely enough to buy a coffee, but the habit of investing regularly made a huge difference. Week after week, I was building my portfolio and, without even realizing it, I was growing my wealth. Consistency also helps you avoid the temptation to time the market. Many people try to wait for the perfect moment to invest, thinking they can predict when prices will be low. But the truth is, even the experts can't do this consistently. By investing small amounts regularly, you don't have to worry about timing. You're always in the game, and you let time do the heavy lifting for you. Another benefit of consistent investing is that it builds discipline. Over time, I found myself cutting back on unnecessary expenses like dining out or impulse buys, just so I could stick to my investing schedule. That mindset shift from spending to investing was one of the most valuable changes I made. And remember, it's not about how much you start with, it's about starting. Even $5 a week is better than nothing because it puts you on the path to building long-term wealth. The great thing about today's investing apps is that they make consistency easy. Most platforms have automatic investment features where you can set up recurring deposits. For example, you could set it to transfer $20 from your bank account every month or even every week into your investment portfolio. It takes the pressure off because once it's automated, you don't even have to think about it. And if life gets hectic, you can still stick to your plan without skipping a beat. Another thing I want to emphasize is that consistency is where you start seeing the magic of compounding. For example, let's say you invest $20 a week consistently for a year. That's $1,040 in contributions alone. If the market grows by just 7% annually, about the average return over time, you're not just adding money. Your portfolio is growing on its own. And as the years go by, that growth accelerates thanks to compounding. Think of it this way. Every small step you take now is like planting seeds. At first, it might not look like much, but over time, those seeds grow into something bigger. That's exactly what consistency does for your investments. It's not about making huge leaps overnight. It's about making steady progress and trusting the process. So, whether you start with $5, $20, or $50, the key is to make investing a regular part of your routine. It's not about having a lot to invest. It's about showing up for your financial future every single week or month. Trust me, the small steps you take today will make a massive difference over time. Now that you've started small and built consistency, the next key to investing with little money is understanding the importance of research and patience. These two factors work hand in hand to ensure your investments grow and you stay on track. When I first started investing, I felt overwhelmed by all the choices: individual stocks, ETFs, index funds, growth stocks, value stocks. It is just too much. But I realized that research doesn't have to mean reading hours of financial reports. It's about understanding the basics of what you're investing in. For example, if you're buying shares in a company, ask yourself, what does this company do? How do they make money? Are they growing or shrinking? These simple questions can help you avoid investing blindly. A great place to start is with companies or industries you already understand. Maybe you're passionate about a sector like technology. By focusing on areas you're familiar with, it's easier to evaluate whether an investment makes sense. And if you're investing in ETFs, look at what's inside them. Most ETFs list their top holdings, so you can see what companies you're indirectly investing in. Another way to build confidence in your investments is by using free resources. Many apps and websites provide company profiles, stock ratings, and even beginner-friendly guides to investing. Platforms like Yahoo Finance or Morningstar can help you get a sense of where your money is going. The more you understand, the less intimidating investing becomes. Now, let's talk about patience. This was one of the hardest lessons for me to learn. When I first started investing, I wanted to see immediate results. I'd check my portfolio daily, hoping for big gains. But the truth is, investing isn't about overnight success. It's about long-term growth. The stock market naturally has ups and downs. Some days, your investments might lose value, and that's completely normal. The key is to stay patient and stick to your plan. Remember, you're in this for the long haul. History shows that the market tends to grow over time, even after big dips. By staying focused on your goals and ignoring short-term noise, you give your investments the time they need to grow. Another tip is to set realistic expectations. If you're investing small amounts, you're not going to become a millionaire overnight. And that's okay. The goal is steady, sustainable growth. Celebrate the small wins, like your first dividend payment or reaching your first $1,000 invested. These milestones are proof that your strategy is working, and they'll keep you motivated to keep going. Finally, surround yourself with positive influences. Follow financial creators who encourage smart, patient investing instead of those promising quick riches. Join communities where you can ask questions and learn from others. Investing can feel lonely at times, but when you connect with like-minded people, it becomes easier to stay the course. So, take the time to research your investments, embrace the ups and downs, and focus on your long-term goals. The combination of small, consistent contributions, smart choices, and patience is incredibly powerful. Trust the process, and you'll see your efforts pay off over time. When I first began investing, I was cautious about losing even small amounts, so I took the time to test my ideas before putting my money at risk. Backtesting became an essential part of my strategy. It helped me understand if my approach had real potential without the fear of losing it all. If you want to avoid costly mistakes and feel more confident in your decisions, check out this video on how to backtest a trading strategy. It's a great way to ensure your strategy is sound before you start investing, helping you make smarter, safer choices in the market. Until next time.